Alright, so in this video, I want to talk about how you can create your own dividend or even boost your dividend. So I follow these channels here, Andre Jake and PPC Ian, and they talk a lot about dividend investing and how great it is and how it is the simplest passive income you can generate for the future. But that's the problem. That's something that I don't like about dividend investing. I do think it's great, but I do find that it takes time to build. It takes capital as well. I mean, most companies will pay a 4% dividend. A good company, a safe dividend is about 4% per year. So if you've got $100,000 in capital, that's $4,000 a year. So it's not enough to live off, of course, and not everyone has $100,000 in capital. So it definitely takes time to build. But what's great about it is definitely the most and truly the most passive income you can get, because you absolutely don't have to do anything to receive it. It just comes in automatically into your trading account and you just have to withdraw it and spend it. And even building it is easy. It's just that it takes time. You have to consistently contribute, reinvest the dividends to buy more of these stocks that pay dividends, and so on and so on. But there is this quite simple way of actually creating your own dividend on a stock that doesn't pay a dividend, because not all stocks pay dividends. So Coca-Cola, of course, pays about 3 to 4% dividends right now. For example, if you look it up over here, Coca-Cola in my broker account, you could see that it pays about 3.83% dividend per year. If you look up Johnson & Johnson, for example, pays about 3% right now in dividends. If we look at ExxonMobil, although their dividend is probably not really safe right now because it's quite high, 9.42% dividend yield right now. But not all stocks pay a dividend. For example, if you look at Facebook does not pay a dividend. But what if you want to own stocks and you want to invest in dividend stocks, but your favorite stock doesn't pay dividends? So there's a quite simple way of generating a dividend from any stock and actually boosting the dividend of a stock that already pays dividend. But I don't understand why these two channels here don't talk about it. I mean, they talk a lot about dividend investing, and I think it would be great if they could just mention that extra part, which would help boost their dividends. And the reason I've got Warren Buffett in the thumbnail is because he is the king of dividends, and he definitely does this following strategy, which is selling covered calls on his positions. And I'm going to use this video by Skyview Trading just to explain what a covered call is, because they explain it so well. So when you buy 100 shares of a stock, you're able to sell a call option against your 100 shares of stock. Now, selling that call option is what's called writing a covered call. Now, what that gives you is it allows you to sell premium. So you're actually collecting income. You're collecting money for selling that call option. Now, of course, selling that call option isn't for free. There's a risk. There's a consequence for selling that call option. That consequence for selling that call option is, first of all, when you sell a call option, there's an expiration. It's a contract. Comes with an expiration. Comes with a time frame. And when you sell a call option, it comes with a strike as well. So, for example, if you buy 100 shares of a stock at $75 and you decide to sell a call option at an 85 strike, as you could see here, what that means, with a 30-day expiration, so the contract has a 30-day expiration, so that means you collected $2 from selling that call option. Now, at expiration, which is 30 days later, if the stock is trading above $85, what's going to happen is you're going to be forced to sell your shares at $85. So you bought it at $75, you collected $2 for selling that call option, but if at expiration the stock is trading above $85, you have to sell your shares at $85. That's the general idea. That's the risk. That's the consequence of selling a call option or writing a covered call. But most of the time, if you pick a far enough strike, most of the time your call strike will not get tested. Of course, if you pick an 80 strike or a 76 strike or even a 75 strike, then you've got a better chance of being forced to sell your shares at that strike price. Now, the closer you are to $75, of course, the higher the premium. The further away you are from the current market price, the smaller the premium. But if you're a dividend investor, your goal is to keep the stock forever and just keep collecting the dividends, reinvest the dividends. So you're already making maybe 4%, 3% per year from the dividends. So with this strategy where you sell a covered call at a strike that's pretty far from the current market price, you're basically just boosting that dividend, creating an extra income to your dividend to get there faster. So really the biggest risk with selling a covered call is if you're someone that wants to keep the stock, you might be forced to let it go at the strike that you sold your call option at. But that doesn't happen all the time, especially if you sell a call option at a strike that's far from the current market price. And even if that happens, you can actually buy back the call option and then sell another call option a little bit further at a further date, and you could do the whole transaction for a credit, depending on, of course, how far the stock is trading above your strike price. But if to begin with, you've sold a call option at a far enough strike, you've got a pretty good chance of keeping your shares. So this really is worst case scenario if the stock blows past your strike, which is already far from the current market price. But if you buy the stock at 75 and you sell a call option at an 85 strike and then the stock drops to 67, you're a winner because you ended up keeping the premium, and you actually, instead of owning shares that are now down to 67, for example, you still own these shares, but instead of being down $8 per share, you're actually only down $6, for example, because you've collected premium from selling that call option at an 85 strike. If after 30 days the stock is trading in the same range, well, you're also a winner because you collected premiums for free. So really the only scenario that's risky is if the stock blows past your strike, but which won't happen quite often if you choose a strike that's far enough from the current market price. And even if that happens and you still want to keep your shares, there's still a way to keep your shares if you buy back that call option that you sold and then immediately sell another one for the following expiration period. So if you look at Facebook, for example, Facebook doesn't pay any dividends, but you want to buy and hold Facebook forever, but you want to generate income from it. So what you could do is, if you look at, so you buy 100 shares of Facebook. So that's another problem with covered calls, is you need to own at least 100 shares or any multiple of 100 shares. So 100 shares, 200 shares, 300 shares. But for some stocks, it's very doable. For example, like Coca-Cola, which is trading in the 40s right now, that's $4,000 US to buy 100 shares of Coca-Cola. So back to Facebook. If I bought 100 shares of Facebook at 166 and I want to keep Facebook forever, but I want to generate a sort of dividend from Facebook, so I can sell covered calls on it if I have 100 shares. And for example, if I go to a strike, if I want to keep Facebook and never want to sell it, then I want to pick a strike that's far from the current market price. If the current market price is 166, now I've got several expirations. So there's weekly expirations and monthly expirations. So if the stock that you own has weekly expirations, it's best to choose weekly expirations because a stock can do a lot of things in 1 month, but in 1 week, it could move for sure in 1 week, but it's not going to move that much, or at least the movement is more predictable, more manageable. So if we take April 3rd expiration, for example, which is 4 days away, if Facebook doesn't have earnings that week, how high up do you think Facebook can move in 1 week if it doesn't have earnings? It's trading at 166. Do you think in 1 week it could be at 180, 185? Who knows, right? But there's a good chance that it's not trading at 180 or 185 by the end of the week. But let's see how far we can go. So I said the current market price right now is 166. You could go all the way to 180 and collect $39 from this stock in 1 week. You could go to 177.5 strike, collect $73. You can go to 175, which is 10 points away, collect $1 from this. You could go to 185, collect $16 from this covered call position in 1 week. And if you want to see what rate of return that would be per year, let's go with the 180 strike. So $39 or 39 cents. So 39 cents divided by my cost of 166 times 52 weeks. That's about 12%. So you've just generated 12% return on a stock that doesn't even pay dividend. Now, right now, we're lucky because VIX is so high, volatility is so high. It's at 56 right now. So when VIX is high, option premiums are higher. So you're able to actually, because of that, you're able to go even further out and collect a decent premium by being super far from the current market price. Usually when VIX is at 15 or below 15, you're probably not going to be able to go that far out. You're probably going to be closer. But at the same time, if VIX is low, then volatility is low. So the stock isn't expected to make that much movement. But let's say Facebook does end up moving from 166 to 185. I mean, you're still a winner because you've collected that much capital appreciation in 1 week, plus a little bit of premium. And if you really want to keep the stock, you could buy back that call option and sell the next week's call option for a credit. Also, once again, a little bit further out. So Facebook went from 166 to 185 in 1 week. It's not going to go to 185 to 200 in the following week. It's going to be a bit more stable the following week. So for example, I want to give you an example of a covered call trade I'm doing right now. So sadly, I bought 100 shares of the Qs at an average price of 228. So that's pretty high, of course. Now the Qs dropped all the way down to the 160s. So what am I going to do? So all I'm doing right now is I'm selling call options or writing a covered call on this position every week. So at the furthest strike possible, because of course, like I said, when you sell a call option, the risk is you could lose your shares at that strike if the market price surpasses that strike at the expiration. So if I look up all my execution on the Qs, so you could see that the last one I sold was a March 31st expiration at a 199 strike. So as long as the Qs don't surpass 199 come March 31st end of day, I keep this $28 that I collected on it. And then the last one here was March 27, which is last Friday, at a 197.5 strike. So as long as the Qs don't surpass 197.5, I keep $35, which ended up happening. And then the week before that, March 20th, I sold at a 205 strike, collected another $35. Then the week before that, March 13, I sold at a 214 strike, collected $39. Ended up keeping that because of course the Qs was way far from 214. I did the same thing with IWM. I bought 100 shares at an average price of 157. The ETF is trading at 115 right now, so I'm down $4,281 on the underlying stock. But what am I going to do in the meantime? The best thing I could do is write covered calls on it, generate income from it, or reduce the cost basis on the stock. Now, the stock was trading at around 112 yesterday. I sold a call option at a 119 strike, expiring March 31st. So that's the expiration. And as long as IWM stays below 119 come March 31st, then I keep the $38. And if I look up my executions on IWM, you could see that this is the $38 I just mentioned. But last week, March 27th expiration on a 116 strike, collected $30. And actually last week, this 116 strike was tested. IWM traded above 116 last week on Thursday. But then on Friday, it dropped. So it dropped below my strike. So I was lucky. I ended up being safe, not having to sell my shares at 116. And my option expired worthless. So I was able to sell another call option this week. But if it stayed above 116, which wasn't supposed to, because when I sold that call option at 116, IWM was trading, I believe, at 103. So it made a big move that week, which isn't the normal behavior. But because my strike was as far as possible, I ended up being safe. I didn't have to buy back the call option. The week before that, expiring March 20th at a 125 strike, collected $25. Now, I'm just going pretty far on purpose just to be safe, but you can actually get closer and get a higher premium. But then you might end up in a position where your call side is getting tested. So if you don't want that to happen, then you want the furthest call strike possible, especially if your goal is to keep the stock forever for dividend purposes, and you're just trying to increase your dividend or create a dividend in a stock that does not pay dividend. And you can see the week before that, March 13 at a 142 strike, collected $34. So just trying to generate income from a losing position, but it's a position that I want to keep forever. In addition to all these call premiums that I'm trying to sell on it, IWM does pay a dividend, not that high though, but it pays a dividend of 1.86% per year. So in your broker account, for example, with Questrade, if you already own the position, you already have 100 shares of that stock, and you want to sell a call option against it, pretty simple. You just look up the option chain. You stay under calls and puts. You choose the expiration. I recommend to choose always the closest expiration, but usually what's more popular is the monthly expirations. But then if you're 1 month away, you can go further away, but a lot can happen in a month, in my opinion. I find that you're more exposed to ending up with a call option that gets tested. So I prefer weeklies, but going as far as possible. So for example, if I go April 3rd, I can click on calls, And by default, Questrade only shows me 9 strikes, but I can choose more. I can click on it, click all, and then I'll go as far as possible. That's really up to you, depending on how much premiums you want to collect, how much return percentage-wise you want to collect as well. But you want to go, in my opinion, you want to go as far as possible if you want to keep the stock, so that you don't get, so that the call option doesn't get tested. And as you can see, I could go all the way up to the 120s if I want. Now, of course, you have to keep in mind the commissions. So with Questrade, commissions are quite high for selling options. For example, if I sell this strike here, the 127 strike, collect $28, $11 of that is going to commission. So that's not really good, right? Almost 30 or 40% of the call premium is going into commission. So that's not good. So maybe you would want to sell something at $59. Even if you have to pay $11, then it's not so bad. And if you have active trader pricing with Questrade, it would cost you about $5.75 per contract. So it would cost you about $6 to sell a call option. So definitely you have to consider commissions when selling options, because it will take a big chunk of your profits. So really quite a simple way to generate a dividend from a stock that doesn't pay dividend, or actually boost your dividend on a stock that pays low dividend, simply by writing covered calls against your position. Two main risks or consequences or bad things about it is, first, you have to own at least 100 shares. So a multiple of a multiple of 100 shares. So 100, 200 or 300 shares of a stock. So it could be a lot of capital. And then when you sell that call option at a particular strike for a particular expiration, you risk losing your shares at that strike price if that strike price gets surpassed by expiration. But there's ways around it. You could choose a far enough strike that has a low chance or a small chance of getting tested. And even if you do get tested, you can buy back the call option and then sell the next week's call option for a credit, hopefully. All right, so if you have any questions, leave them in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.